今天为大家带来的分析影片非常的精彩，作者是 Joe scarcity， 一位坚定的比特币建设者、宏观经济分析师，非常善于使用确定的数据解读比特币和全球的宏观经济。在这支影片里，Joe结合美联储主席换届、华尔街的大举进入以及一系列扎实的比特币指标数据，从5个阶段分别是流动性增加、实际利率转负、被迫买入风险资产、股市熔涨和比特币补货来分析股票市场和比特币市场目前所处的阶段，并且呢对后市做出了明确的预测，思路非常清晰，数据扎实。对于想要学习宏观数据分析的朋友，也是一个相当不错的范本。为了保证大家观看的流畅性，在正片开始之前，我先给大家解释一下影片中出现的一些概念。Melt up 熔涨是指资产价格，尤其是股市在缺乏强劲的经济基本面支撑的情况下，出现急剧猛烈而且是非理性的暴涨。那一个正常的牛市是建立在经济增长、企业利润增加的基础上，但是熔涨则不同，它通常具有以下特征：第一个，脱离基本面，企业的实际获利能力并没有显著的提升，经济数据可能也很一般，但是股价却一直狂飙。第二，估值极端荒谬，股票的 PE 或者总市值占 GDP 的比例会达到历史的极端高位。第三，垃圾股齐飞，在熔涨的末期，不仅是好公司在上涨，连那些品质最差、基本面也不好的小型股或者高风险的垃圾债券也会跟着暴涨。熔涨通常是因为央行大规模的印钞或者降息，向市场注入了大量的资金，导致的流动性泛滥。当通货膨胀率高于名义利率时，把钱放在银行或者购买无风险的国债，资金的实际购买力其实是在缩水的，也就是每天都在亏钱。因为持有现金会贬值，所以投资人被逼着去买股票、买高收益的债券、买比特币来保值。这种不计价格的资金涌入，直接把市场推向了熔涨阶段。在熔涨的阶段，市场会有强烈的 FOMC 情绪，很多本来观望的人会失去理智，在高位追涨，这会造成轧空行情，导致资产价格进一步的暴涨。 OK， 接下来让我们一起来听一听Joe精彩的分析。
So the stock market just hit fresh all-time highs yesterday, and every traditional finance pundit on the planet is celebrating it. The bull market is back, the crisis is over, just buy the index and go to sleep. But Bitcoin is telling a completely different story. It's sitting 18% below where it was a year ago, and the bears are paying 19% interest to short it, which is the highest rate since early 2023. Institutions just bought 93,000 Bitcoin in the last 30 days, and Paul Tudor Jones, one of the greatest macro traders alive, just went on television and called Bitcoin the greatest scarcity asset there is and the best asset for what's coming next. And tomorrow at 2 p.m., Jerome Powell holds the last Fed meeting of his entire career. So who's right? Stocks are saying one thing, Bitcoin is saying something else, and only one of them is right. Is it the stock market telling you that the bull market is back, or is it Bitcoin sitting in no man's land while the bears bet against it? Is this the death of Bitcoin's cycle and we're going to bottom out and start the bull market in October? Or is this the calm before Bitcoin lights the entire risk curve on fire? Well, by the end of this video, you're going to have a clear read on exactly where we are, what's driving it, what tomorrow's final Fed meeting from Jerome Powell means for the regime that's about to take over, and how to position for what comes next. Whether the bottom is already in, or whether we get one more leg down to the lows before the real move starts. Let's get into it. So here's the chain of events I want you to keep in your head for the rest of the video. We have 5 steps: liquidity, real rates, forced buying, equity melt up, and Bitcoin capture. Memorize them. This thread is the entire thesis. So step 1, liquidity. The S&P 500 closed at fresh all-time highs yesterday. So did the NASDAQ. AI names are, of course, dragging both indexes higher on the back of data center build-out, which is becoming the marginal driver of U.S. growth. Liquidity in the system is increasing, and as I mentioned in the last video, real rates in the U.S. are very close to turning negative. And when real rates go negative, holders of T-bills lose money in real terms, so they're forced out on the risk curve to buy equities, take on credit risk, and of course, buy Bitcoin. That's not sentiment, that's just the way that these cycles play out. It's very favorable for risk assets. And you already know that this is happening because if you take a look at some of the lowest quality small cap stocks, they've started to rally. Junk bonds are also getting bid. That's not what a market top looks like. That's what the early innings of a melt up look like. Now, I want to spend a minute on what Paul Tudor Jones said about Bitcoin because what he said this week is one of the most important Bitcoin moments in the history of the asset, and I haven't seen a single mainstream outlet treat it the way that it deserves. So Paul Tudor Jones is not a Bitcoin guy. He is one of the greatest macro traders to ever live. He called the 1987 crash, and he's been managing money at the highest level for 40 years, much longer than I've been alive. And this week on national television, he said, and I quote, "Bitcoin is unequivocally the best inflation hedge that there is, and it has the greatest scarcity value of anything." Take a listen.
And then in 2020, when you saw, again, all the interventions, both by the central bank and the Treasury, you just knew that the inflation trades were going to take off. And what was, of all of them, what was the best one? At that point in time, it was Bitcoin. Bitcoin is unequivocally the best inflation hedge that there is, more than gold, because Bitcoin is finite. There's only so much Bitcoin that can be mined. The problem with it as an inflation hedge is if you got into kinetic exchange, there's clearly going to be cyber warfare, and anything that you have to deal with electronically is going down, including Bitcoin. So strike one. And then secondly, quantum computing, who knows if and when, with AI advancing as fast as it is, that we may actually have quantum computing. Now, quantum computing, someone can come in and can hack any bank and hack anything they want to. So in terms of it being a great inflation hedge, gold increasing supply every year by a couple of percent. Bitcoin, there's a finite amount that can be mined. It's decentralized. And so in that sense, it has the greatest scarcity value of anything.
So unequivocally, the greatest scarcity value of anything. That's not the language of a guy who's hedging his bets. This is one of the most respected macro voices on earth saying that Bitcoin is the answer and it's the asset that you should be holding for what comes next. Now, the part of what he said that should make everyone watching this video stand up straight is when he talked about the risks. When he talked about Bitcoin's risks, he listed two highly theoretical tail scenarios, very not concrete, very nebulous. But when he talked about the risks of owning gold, he mentioned structural dilution, which is a concept that I've been talking about on this channel for some time, which is that Bitcoin is a better hard asset than gold, because whereas gold is relatively scarce, Bitcoin is absolutely scarce. Well, what do I mean by that? When gold's price goes up, there is a supply response function. It incentivizes miners to bring more gold out of the ground, thus putting a damper on its price. Whereas with Bitcoin, it can rise to $1 million tomorrow. Miners cannot change the supply schedule. So ultimately, Bitcoin is the better asset you want to own in the event of money printing. Now, Paul Tudor Jones is saying the exact same thing. He's telling you that the gold bug case is structurally weaker than the Bitcoin case. This is the institutional macro world arriving at the conclusion that Bitcoiners have been screaming for 10 years. When Paul Tudor Jones says something like this, the rest of the mainstream macro world is going to listen. And it's happening at the exact moment when the Fed is about to enter the most aggressive easing cycle of the modern era, as Kevin Warsh is about to step up to bat. Because in the same breath, Paul Tudor Jones also laid out the bear case for stocks. He said the US stock market is at 252% of GDP. Now, for context, in 1929, just before the Great Depression, that number was 65%. In 1987, it was 90%, and at the peak of the dot-com bubble in 2000, it was at 170%. Today, we're at 252%. So he said that if the market mean reverts to the 25 or 30-year average earnings ratios, that's a 35% decline. That kind of move would wipe out about 90% worth of US GDP in market cap and trigger a self-reinforcing collapse in tax revenue, in the budget deficit, in the bond market all at once, which would force the Fed to print even more than I talked about in the last video. So here's the paradox. The case for a melt-up is right, and it's already underway, but Paul Tudor Jones is also right. They're not contradicting one another. They're describing the same trade in two different time frames. Liquidity goes in, markets melt up, valuations go to absurd levels, and then the music stops. And Paul Tudor Jones is telling you what the destination looks like, and he's also telling you which asset to be holding when you get there. Now, I want to talk about the catalyst that almost nobody is connecting to any of this. And in my mind, this is the single most important event happening this week. Of course, that is Jerome Powell's Fed meeting, the last FOMC meeting that he's going to have as Federal Reserve Chair tomorrow at 2 p.m. Let me say that again so that it lands. Tomorrow is the last rate decision that Jerome Powell will ever lead. This is a man who has built his entire career on keeping the Federal Reserve's goals separate from the Treasury's goals. And after tomorrow, that wall comes down and it does not get rebuilt. Kevin Warsh is already going through the Senate confirmation hearings to become the next Fed chair and replace him. And he's been telegraphing for months that he wants to cut rates aggressively, not because the economy needs it or inflation is solved, but because the Treasury needs lower yields to refinance its debt. And the next Fed chair is going to give it to them whether the data justifies it or not, widening the K-shaped economy, making it so that asset holders benefit and the asset poor are worse off. And that's why I'm telling you all of this. This is the regime shift that recalibrates everything else in this video. We were already on a path to negative real rates, but if you layer in aggressive rate cuts on top of that from a Fed chair whose explicit mandate is fiscal accommodation, that is a debasement regime. And there is exactly one asset on earth designed for that environment. Now, I want to put a real piece of tension on the table because I'd be doing a disservice if I didn't. There is a version of this story where Bitcoin's failure to break higher right now is the canary in the coal mine. So as you know, Bitcoin tends to lead risk assets both ways. It topped before stocks in 2021, and it bottomed before stocks in 2022. So when stocks are printing fresh all-time highs and Bitcoin is sitting 18% below where it was a year ago, refusing to clear very key resistance levels of $80,000, one read on that divergence is that Bitcoin is telling you the stock market rally is the last gasp before the end. That's a real possibility. I'm not going to dismiss it. But here's the other read on what's happening, and I think it's the more probable one. With Kevin Warsh on the way, and real rates about to flip negative, with ISM expanding as the US economy does well, and ownership of Bitcoin from long-term holders going vertical, the more likely explanation for Bitcoin's hesitation is that it is coiling rather than breaking. So in my view, the bears are reading the chart in isolation, whereas the bulls are reading the regime. Both can't be right, and given the regime shift that's about to happen tomorrow, I am betting on the bull case. Which brings us to Bitcoin specifically. Because if you're sitting in Bitcoin right now, watching it chop sideways at $76,000 while the stock market prints record highs, you're probably feeling left behind. Well, let me show you what's actually happening under the hood. As you can see right here, long-term holder supply just went vertical. So this is the cohort that holds Bitcoin for 155 days or more, and it shows that they are allowing their coins to age very fast. That is the single most important on-chain signal in any cycle, and it's screaming right now. Institutions also bought roughly 93,000 Bitcoin in the last 30 days. You also have BlackRock's IBIT, which pulled in $983 million in a single week, which is the highest in 6 months. And you also have net institutional demand growth for Bitcoin, which just reaccelerated to the highest level since late 2025. So here is the obvious question. If the setup is so bullish, why is Bitcoin still 18% below where it was a year ago? Why hasn't it broken out yet? Well, there's one reason for that, and that's because of a level Bitcoin hasn't cleared yet. That level is the true market mean and short-term holder cost basis, which are both sitting around $79,000. Breaking above $79,000 and closing there would put the average active investor in Bitcoin and the average recent buyer and also almost every ETF investor back into a state of profit. For months, the default behavior has been sell the rip, and that's how you know you're in a downtrend. The tipping point is when enough people are back in profit that the buy the dip becomes the dominant behavior. We are right at that line. So Bitcoin hasn't flipped it yet, which is why the bears are so confident and why they're paying 19% interest to short it. So I'm going to be honest with you, the technicals are not yet confirming a bull trend. Bitcoin is still trading inside its 100-day and 200-day moving averages, which have acted as perfect resistance all the way back in January. The weekly structure is quite bearish, and Bitcoin is still trading underneath its 400-day moving average, which is the cleanest bear market indicator that I track. So until Bitcoin closes and holds above that $79,000 level, the structure suggests that we are still in a relief rally inside of a downtrend rather than a bullish reversal. And don't forget what's right around the corner on the calendar, which is sell in May and go away. You can see on this table right here, every time Bitcoin is in a bear market year, the seasonal pattern is to sell during the summer and then buy back in the fall. So the bottom might not be in yet. But here's what's also true. The percentage of long and short-term holders sitting at a loss is at almost the exact same level that it was during the 2019, 2020, and 2022 bear market bottoms. And you also have ISM manufacturing PMI rising above 50 from contraction into expansion as the US economy expands. Let me say that last one again. ISM expanded above 50. That is the single most reliable economic precondition for a Bitcoin bull market in the last decade. Now, let me come back to this thread, this chain of events: liquidity, real rates, forced buying, equity melt-up, and Bitcoin capture. So where are we right now? Well, liquidity is increasing, real rates are about to go negative, and tomorrow's handoff from Jerome Powell to Kevin Warsh in May accelerates that. Forced buying is starting to show up in small cap stocks. The equity melt-up is kicking off, which is why stocks just hit a record high. So we are in the early stages of step 4, and Bitcoin comes next. Because Bitcoin is the highest beta expression of global liquidity, and as Paul Tudor Jones just told the world, it has the greatest scarcity value of anything. And speaking of demand rising from every direction, look at what just happened in the last 6 months on Wall Street. Bank of America allowed advisors to start recommending Bitcoin ETFs in January. Morgan Stanley launched its own Bitcoin ETF in April, which became the most successful ETF launch in the firm's history, pulling in over $100 million in its first week. Goldman Sachs filed for the Bitcoin Premium Income ETF 2 weeks ago, and Charles Schwab is rolling out direct Bitcoin trading to its 38.9 million brokerage accounts, which manage $12.22 trillion in client assets. I covered the Schwab and Morgan Stanley stories in detail in their own videos, so I'm not going to rehash them here, but look at what the headline pattern is telling you. 6 months ago, the largest financial institutions in America were on the sidelines, and today they're effectively racing each other to put a Bitcoin buy button in front of their clients. That's plumbing that's being laid for the next leg of this bull market, whether that leg starts next week or in 6 months. The rails are now in place that were not in place during any prior cycle. So if you've been following my work for a while, you already know I think Bitcoin is the asset best positioned to capture the AI revolution that we're living through right now. The data center build out, the liquidity that it requires, and ultimately the deflationary impact of AI that's going to be responded to with a massive print from the Federal Reserve in order to keep the credit-based global economy chugging along. All of that ends up in Bitcoin because Bitcoin is the cleanest store of value for capital that has nowhere else to go. So if you want me to make a video on that next, drop the word revolution in the comments and I'll know to prioritize it. Now I want to talk to you directly for a second because I know what watching this video feels like if you're holding Bitcoin right now. It's demoralizing. The stock market prints fresh all-time highs and Bitcoin just sits there refusing to join the party 18% below where it was a year ago. You feel like you're holding the wrong asset. You feel like you missed it and you feel like everyone who just told you to buy the index was right and you were wrong. But I want you to remember one thing. This has happened time and time again. When Bitcoin eventually moves, it is always the fastest horse in the race, always. Every cycle without exception. Whether that move starts this week or whether we revisit the lows one more time and it doesn't start until September or October, it does not change the destination. It's not an if, it's a when. And the people sitting in cash right now waiting for the all clear are going to be the same people chasing it from $120,000 to $200,000 the exact same way they chased it from 30K to 70K last cycle. So let me bring this home for you. Liquidity is increasing. Real rates are turning negative and capital is being forced out the risk curve into equities. The melt up has begun, which is why stocks just hit a record high. Bitcoin captures next because Bitcoin has the only fixed supply on Earth and demand is hitting it from every direction. The plumbing is late. The $79,000 cost basis is the only line standing between Bitcoin and a fresh all-time high. And tomorrow at 2 p.m. Eastern, Jerome Powell makes his last Fed decision, and the wall between the Fed and the Treasury that stood for the entirety of his career comes down with him. Stocks are saying that the bull market is back, Bitcoin is saying something else entirely, and Paul Tudor Jones, the greatest macro trader of his generation, just told the world which asset to be holding when the next regime takes over. The melt-up is the appetizer, but Bitcoin is the main course. And the bear market that Paul Tudor Jones is warning about is the dessert that nobody wants to eat. But thankfully, that dessert is years away. And between now and then is the largest forced repricing of risk assets in our lifetime, with Bitcoin as the fastest horse in the race. And one last thing, if you watched all the way to the end, drop the word liquidity in the comments so I know who actually made it. I'll see you in the next one.